welcome to Pathbreakers. I'm Neha Bothra. My guest today is one of India's most famous and successful fund managers. He has the distinction of being the only fund manager in India to directly manage assets worth over 1 lakh crore rupees. Over 3 decades, he has returned to investors nearly 20% versus an index return of about 10%. In a very rare interview, Prashant Jain talks to us about what it takes to be the Don Bradman of the mutual fund industry. Stay tuned to Pathbreakers. In the first of a two-part conversation, Prashant Jain delves into the core of his investment philosophy and takes us through his learnings as he navigated several market cycles over the past 30 years. Sir, thank you so much for joining us on Pathbreakers.
No, my pleasure. The pleasure is entirely mine. Thank you.
Let me take you back in time, IIT Kanpur and then IIM Bangalore. So you were a very good student, evidently.
Yes, I did quite well in academics, yes.
And which were your favorite subjects?
So I have actually been avoiding what I did not like. I mean, that's how I moved into mathematics, because I did not like biology. And I moved to IIM because I wanted to study more and not go abroad. I had actually gone to IIM with the intention of writing civil services.
All right.
But and I qualified also, but at the last moment I decided against joining.
So how did you get into equity research?
So it was an accident, and I actually wrote the civil services, but I took about a month extra time to decide not to join. And I had joined SBI CAPS. Those days it was a day one company on the campuses. And when I reached SBI CAPS a month later than most of my other batchmates, the GM was very apologetic and he said, Ki, all the good departments are gone. I'm sorry, I can offer you only equities research. So those days equity research was not a sought after career. But I think it was good that I joined about a month late, because I really enjoyed it. And that is how I started in equity research.
What did you most like about equity research? The understanding of businesses, interacting with managements. What was the one thing that actually made you stay in the profession for so many decades?
No, I think you are constantly learning. While you are learning, you are also dealing with the uncertainty of the future. And you are being constantly tested. Your opinions, your views, your conclusions are being constantly tested and challenged in the marketplace. So I think it's a very exciting, evolving, challenging field, and the pace of change, I think you just keep on learning, and I have found it to be extremely engaging.
The mutual fund industry was at a very nascent stage, I would imagine, 30 years ago. So were you among the first ones to venture into the domain of fund management from equity research? It seems like a logical progression now.
The industry was extremely nascent. There were, I think, just about 2 or 3 fund houses. UTI was there, SBI Mutual was there, and Canara Bank Mutual Fund was there. So while I was at SBI, I think just about after a very short while, maybe 1 year, 18 months, I was made a scheme in charge. It is different from a portfolio manager.
Okay.
And those days it was actually quite easy to move into fund management, because as I said, equities was not a sought after career at all. And as you also said, it was a logical progression. Very few professionals were in the industry, and therefore when the opportunity came to become a portfolio manager, I certainly took it on.
At that time, did you know that your stint would be better than that of Don Bradman? You survived for 30 years in this space, the longest serving fund manager. Was this something you imagined at the time when you took this call?
No, I have actually not thought too much into the future, to be honest. At any point of time, I have tried to do my best every single day. But one thing I do recall, I was quite keen on that whatever funds I manage, I should run with them for as long as possible, and hopefully try and create some kind of a track record. And that is why, despite the business getting sold or changing shareholders 2 or 3 times, I stayed put. So that desire was there, that once you are managing a fund, let's manage it for as long as is possible.
Mhm. Also, tell me one thing, I find it very intriguing that equity research wasn't something you were very familiar with. So, did you find early mentors who groomed you, anyone who influenced you professionally in terms of shaping your investment principles and philosophy?
I think I am a quick learner. Whenever I talk to someone, I learn a few things in practically every conversation, and I also read a lot. And there are a whole lot of people whom I have learned from. One of my earliest colleagues was Sundaram. It was he who explained to me the very basics of equity research, and we were together at SBI Mutual Fund, and then we also moved together to the startup 20th Century Mutual Fund, which over time became Zurich India Mutual Fund, and in turn over time became HDFC. It got bought over by HDFC Mutual Fund.
So tell me, what is your method, sir? You are very process oriented, am I right? How have you perfected your methodology of investing in stock markets?
See, we are all dealing with lots of uncertainty, and therefore one is constantly testing whether your hypothesis, your thought process is right. I mean, I have been worried at times that are you on the right course? And I think that worry, that bit of insecurity about your conclusions is very good to have, because that keeps you open to fresh ideas and it accelerates your learning. The core of my investment philosophy has been pretty consistent over 3 decades. But of course, your experience, your understanding of how to execute that has improved considerably over time. So if I may say, I have always tried to avoid unsustainable businesses, because when you invest in something that is unsustainable, then whenever market prices it appropriately, the losses are permanent, because something was overvalued, and that overvaluation goes because it did not deserve that value. Quality was weak, sustainability was not there. So when markets come round to that fact, the destruction in wealth is permanent, and even over 10 years you are unlikely to recover that capital. The second thing what I have always been focused on, and I guess it comes from your genes or your background, that you don't want to overpay for anything in life. You want to buy things at a reasonable price. So I have always kept a sharp eye on what are you getting for what you are buying. So even good quality companies can sometimes become terribly overvalued, or so overvalued that even over 10-20 years they will give you zero or negative returns. And that has happened to the consumer companies, it has happened to pharmaceutical companies, it has happened to IT companies. So practically every good quality company has at some point or the other become so overvalued. Even over 10, in some cases even over 20-year periods, returns are not there. And if you don't meaningfully overpay, then it helps you generate better returns over long periods of time. So these are two principles: buy decent quality, avoid weak quality, and don't sharply overpay even for good quality. The turning points in markets are extremely hard to forecast, and what you win over 3 years, when the time comes it goes away, and more than that in 6 months time. And that's why I think it is very important to stick to a process, a discipline which is sustainable and grounded in reality.
And you have stuck to these principles over the decades, and this is something you are so highly respected for in the industry. But it must be tough, isn't it? I mean, at the turn of every decade, there's always a new wave that comes along, and there's this enthusiasm to participate in it. You dodged many bullets by not doing that. The dot-com bubble is an example. But would you say that it also meant losing out on some big opportunities? Take Asian Paints, for example, Bajaj Finance, another example. These are names that you yourself highlighted as mistakes of omission.
There is no one who will buy all the companies that go up. I have made more mistakes of omission than of commission, but I am extremely happy about that, because what it means is that I have not lost money. on most of the companies that where we have bought, and that is the key to this. And we are all limited by our understanding of the future. And as I said, I am not able to see decades. But when you find something good quality but unreasonably expensive, the discipline is just don't participate. In most cases, you will be right, like it happened in the dot-com burst, or it happened around pre-Lehman also. There are a lot of sectors which are overvalued. And it is happening in more recent times also. You have seen some very sharp corrections in some good businesses. But the flip side is that when you stick to the discipline, in some cases you will be wrong. Either the business will do much better than what you anticipated, or the markets may also continue to value it at a very rich rate. So I think these are always possibilities, and we are always learning. So I often reflect as to why did I make these mistakes of omission. In some cases, the businesses have done much better than what one had expected, and when I look back, one should have there were valid reasons for doing that, but I did not realize it at that point of time. See, in equity markets, one cycle can go on for 8-10 years. That is the nature of this asset class. So something what remains overvalued may remain like that for extended periods, and vice versa also. So in some cases, I feel it's just a matter of time before some of those mistakes of omission, which today are mistakes of omission, over time, I think they will not remain like that, because those excesses will over time go away.
Sir, it's remarkable that you stay so true to your convictions, because we all know there are market participants and investors who prefer to go with the tide, and they do not really have hesitation changing their investment approach. How have you managed to stay so true to your convictions? There are so many pressures for a fund manager. You have expectations at various levels. What were the enablers that allowed you, that helped you to actually stay the course and take these bets the way you have? Was it the board, the management, the team?
I have always been fortunate. I have had very good people whom I was reporting to, and they were quite appreciative of what was being done. The boards have been supportive, the trustees have been supportive. And on my part, I have always gone out and engaged with all these stakeholders, whether it was the investors, the distributors, the boards, the trustees, and shared with them, okay, look, what is it, what is the underlying rationale? And you will appreciate that I avoided weak businesses, fraudulent businesses, and that made the job a bit easier. And the value was there for everyone to see. I mean, if something is 4P, it is 4P. It's a sustainable business. First time was really difficult when you sold out of technology in November 99. But the second time, pre-Lehman, when one avoided the excesses, it was easier because you had the past to lean on. And the last time, again, by that time one had built a reputation that twice you have held anti-consensus views and you have been proven right. So it made it easier. But I believe if you succumb to short-term pressures, you are only aggravating the pain. You may postpone or avoid the pain in the short term, but longer term it will lead to deeper pain. I think that investing approach which simply focuses on the direction of price movement is not a sustainable thing. It is very counterintuitive. It is to me that buy something because it is going up, or don't buy something because it has come down. I would behave exactly the opposite. If something has doubled in price, it becomes that much less attractive, and vice versa. So I don't think I can ever do that. It would be against my very, very basic nature, understanding, common sense, whatever. And I am quite okay to exchange long-term gain for short-term pains.
That's very unique and interesting, because most companies have a desire to grow market share, and it always comes by giving incentives for short-term results. So how have you managed to balance this, keeping the long term in mind? Because the long term, as you said, requires some sacrifices for the short term. In fact, as you yourself pointed out, that there was this period from maybe 2013, 2020, when performance took a hit, you stuck to your convictions. How did you navigate that period?
See, it was true that last phase was a bit difficult and a bit extended, and COVID again delayed the recovery of economic sensitive sectors by 2 years. So it was, yes, this 3, 4, 5 year period was indeed painful, but what gave me confidence is because the intrinsic value of the businesses that I was holding on was growing all this while. It is just that for some reason or the other, the price discovery was not appropriate. But I think I understood the businesses quite well, and I was challenging my views, my conclusions practically every day with myself and with the peers in the industry and with my colleagues. And there was no convincing answer, counter argument as to what one was holding was not right for the long term, and the alternatives that one was not holding. I mean, there were serious challenges in some of those business models, and valuations were also extremely challenged. So I think in the end it boils down to your understanding of the businesses and your faith in the efficiency of markets longer term. And I think that is what enabled me to hold on. And I have seen time and again, and even history has taught that to us, that the pain of 3 years may go in 6 months.
Sure.
And the gains are permanent because it is the undervaluation that is getting corrected. So if something remains undervalued for 3 years or 4 years, but when it corrects, the gains are permanent. So the pain is temporary, even though it was extended.
Stay tuned for part 2 as we continue the conversation with Prashant Jain and discuss how he uses his investment philosophy for long-term wealth creation in current times of uncertainty and volatility. Coming soon, stay tuned to Pathbreakers.